All right, welcome back to Financial Clarity for Doctors. I'm Corey Janoff, joined as always by Rachelle Vanderzanden.
Here I am.
There you are on the Zoom camera.
That's right.
If you're watching on YouTube, you can see us. Um, let's see. Today we want to talk about bubbles, one of my kids' favorite things. Not
They're
that type of
amazing.
bubble,
We just
but
went to Disneyland though. Those bubbles
ooh,
were everywhere. We saw this one little kid in a stroller and the mom was not paying attention and it was just like the kid was holding the bubble maker and was literally in like a pile of bubbles because they were all getting caught like on her like chest and
that's fantastic.
those bubbles are good too.
That might
Better
be a
than these
new that
bubbles.
might be a new record for sidetracked, but and then the bubbles popped, I imagined.
I were just soaked
Or
into her shirt.
they just kind
Yeah,
of
ew.
dissolved in grime and
Ew.
soap. um, so yeah, bubble, like in hindsight, you can point to a bubble because it pops, and that was a bubble
Hmm.
when we were talking about investing. Um, in the moment, you don't know if it's a bubble or not. It might not pop. It might just be the new normal. So when we think of bubbles, we think rapid price increase, things getting more expensive, demand exceeding supply, and people freaking out and news headlines being like, "Are we in a bubble? Are we in a bubble?" And you get some talking head calling for the next recession. What is it? The saying economists have predicted 13 of the last seven recessions. Um, Something like that. It's, there's fear is more attention grabbing than everything's all hunky dory. But many of
Bubbles are
you,
often driven by that like fear of missing out too. Like,
there is that
oh,
fear.
like everyone is like making money on these stocks. I better get in on that action and buy some too.
Bingo. Yeah, that's what
Yeah.
creates the bubble. And then it's
Yeah.
you know, the crash part that you don't want to be the last one holding on. So many of
Hmm.
you in our recent times, you lived through the dot-com bubble. Maybe you weren't investing during that period of time. You might have still been a kid. Um, the early 2000s housing bubble that led to the great financial crisis. You're pretty well aware of that one, I'm guessing. Again, maybe you weren't invested at that point in time. Maybe you didn't own real estate at that point in time, but close enough in memory that or familiar with the general premise behind it. Um, and you often see bubbles driven by either one specific sector or even a handful of companies in that sector or one specific thing that's the hot commodity. And and I think right now you're seeing questions asked, are we in an AI bubble? AI, if we didn't have AI, the stock market wouldn't be up. The only reason the stock market's up is because companies are spending all this money on AI. The regular GDP is flat if it wasn't for companies spending on AI. AI, AI, AI. Everywhere you look, it's AI. But is that a bubble? I don't know. Time will tell. Maybe. Um, so I guess what is a bubble, Rochelle? You want to give us our expert
Sure.
definition here?
Yeah, so I think obviously it's not, we don't know until it happens, right? But it can kind of be typified by like a rapid increase in prices that are not supported by companies' underlying values. High stock prices, very little or maybe no profits. I think that the tech bubble was very indicative of that, where companies were spending a lot on like marketing and stuff like that, not a lot of money on product development and like generating profits, which is important long term. So I think we're seeing less of that now, which we'll talk about in a little bit, but that was definitely what happened with that one. There's also, some older examples of bubbles that we don't think about as bubbles anymore because we're focused on the stock market so much. But there's this example of like this Dutch tulip bubble of the 1600s because everybody wanted these tulip bubbles or tulip bubbles, tulip bulbs because they were so excited about tulips and everyone wanted to buy them and was spending enormous amounts of money on tulip bulbs because everyone wanted them that could afford them, and it got more and more and more expensive until people are like, wait, this is dumb. Why are we spending so much money on tulips? And then it falls apart, right? So it can happen in different ways, in different kinds of markets, even when we're not dealing with the stock market.
Yeah, some other
Yeah.
examples throughout history. And feel free to read more into these things. It's all fascinating if you're into history. or even the abbreviated version. But yeah, the Dutch tulip bubble is very interesting. South Sea bubble, you may have heard of that one. South Sea Trading Company had a monopoly on trade with between Great Britain and South America. The company stock skyrocketed and then collapsed. There was the railroad mania in Great Britain in the 1840s, where they were really expanding their railroad network and people were buying railroad stocks. And then expansion slowed, profits weren't what they needed to be to support the stock prices. Railroad stocks came crashing down. The dot-com bubble we talked about. We'll talk
Hmm.
more about here. The housing bubble in the early 2000s, which, that was a whole, you know, domino effect, house of cards. It was more than just housing prices. It was the
Yeah,
lending, it was the rating agencies, it
right.
was the companies, the banks all, borrowing from each other. Um, you know, go watch The Big Short or read the book. They did a good job
So
turning
good.
a not so happy story into a somewhat funny yet serious movie. Um,
Hmm.
Michael Lewis is a good storyteller, but it's that's what causes a bubble. It's that speculation, the herd mentality, the media not doing us any favors, the fear of missing out. Everyone and their friend is making money in this thing. Let's jump in. And we don't want to miss out on those profits. So we're going to buy in too, even if we know nothing about it. And then the bubble bursts and people are less, well, I guess burst in the moment, hard to tell. Like, is this just a temporary dip or things popping? Eventually, the same herd mentality that drove prices up drives prices down. People are worried that prices are going to decline, so they sell, which further exacerbates prices going down, and then more people sell, and it just drives prices down and panic selling, and then and that's that. But you don't know until after the fact if that's the case. And just because
Hmm.
prices go up rapidly doesn't mean they're going to come down rapidly or at all. They might just kind of plateau. In the early 2000s, housing prices took off and then collapsed. Right now,
Hmm.
housing prices have increased significantly in the first half of the 2020s, but there's a supply and demand imbalance to where one could argue, I don't know if housing prices are going to collapse. I mean, the increasing might be unsustainable in certain markets. And we talked about housing, a couple weeks ago or a couple episodes ago.
Hmm.
Um,
Yep.
and we're not even really focusing on housing today. We're talking about bubbles and AI and history and whatnot. But you can kind of look at different examples and make arguments and counter arguments to the counter arguments, and it's hard to make heads or tails of it until after the fact. I think Morgan Housel has a great saying that every what is it? It's like every analyst's valuation is data from today multiplied by a story about the future. And how
Hmm.
do we apply that data to tomorrow to make sense of it, to convince ourselves this is the right price for something?
Yeah. Yeah. I think economics is easy when you're looking backward. It is not easy when you're looking forward. Like you could look at past data and be like, "Oh, that was super predictable. Why didn't people understand that that's what was happening? Blah 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 blah." And then you try to do that with forward-looking information and it's not easy. It's not easy at all. So we're going to tell a little story about what happened in the late 90s and early 2000s with this dot-com bubble because it's fun to talk about history once in a while. But this was exciting. Like the internet was very, very, very cool. We're so used to it now that we don't understand the excitement that was happening in the late 90s about all of the things that we could potentially do on the internet, like the stuff you could sell. Like that was the big thing with companies. Like, what can we sell on the internet? We have this amazing new tool to make money. And, like people were really excited about it. They wanted to be a part of making money on the internet, of like making money on the use of the internet. So lots of companies were trying to capitalize on that in different ways. But there were lots of companies who were putting tons of money into marketing, but not so much into like building their systems and selling stuff and having products and things like that. And there were also lots of companies that went public that did these IPOs so that individual investors could buy their stock, before they really had these profits, they just had ideas. They were like, hey, let's bring this to the market. Let's let people invest in our company, so that we can do more with our company. And then, but it never materialized. Like lots of companies that happened with you. There were companies advertising at the Super Bowl and spending like millions of dollars on ads and still not making any money, which is kind of crazy. So that that I think is a little bit different than today. We'll kind of talk about today in a second too. But the peak happened in like March of 2000 and then things started like fizzling out a little bit. It wasn't like a crazy dip immediately, but investors started to realize that many of these companies would never make profits, that the business models were unsustainable.
I
The
would, well, I guess finish and then I want to jump back to it because I think a lot of
No,
companies are just ahead of their time back then.
yeah,
Like you take
that's
pets.com.
yeah.
I
Yeah, like
mean,
people like they didn't have the
Chewy.
market
Look at
yet.
Chewy.
Yeah.
Like that,
Yeah, yeah, yeah,
fantastic
yeah, yeah.
business. Amazon, like they started out as a bookstore and their stock price I think declined 80 or 90% when the bubble burst, but like they're an
They
exception to where
survived.
they were, building that infrastructure to become what they are today, which is a massive online retailer and web hosting service for businesses worldwide. So I
Yeah.
think, there's a lot of companies that had a good concept, just they were a little too early to the
They
game.
didn't
And
have the
like,
market yet.
yeah,
Yeah.
like Rachelle was saying, like, all right, we got this cool idea. Let's slap .com on the end of it and go public and make money. Um,
Yeah.
but anyways, go ahead. Sorry.
Yeah, I mean, I think one thing that we look at when we think about is this company worth it? Is this stock worth it? Is something called like a PE ratio, which stands for price to earnings. So it's basically like how much are you paying for the stock compared to how much is the company earning? Like the very, very simple way to look at it. And that ratio is historically not crazy. Well, we'll talk about what it is historically, but at that point in time like depending on what valuations you're looking at, what sources on the internet, et cetera, it was somewhere between like 90 and 200 was the PE ratio. The S&P 500 itself reached a PE ratio of like 45 when it's historically averaging more like 16 to 20. So things were what we would call overvalued when we're thinking about the PE ratio.
And PE, I guess for a little context, is the price you pay as an investor for every dollar of the company's earnings. So when you take the stock price, take what is it, the value of the stock divided by their earnings per share. So obviously, the less you have to pay per dollar of earnings is better value. Like if a stock is trading at a PE of 6, you only have to pay $6 for every dollar of earnings. So you're getting a lot more bang for your buck. But now you have to ask yourself, why are they only trading at a PE of 6? That they might not be a very good
Yeah,
business moving forward. A high PE, on one hand, you could argue is overvalued. Like, oh, I have to pay $100 for every dollar of earnings. That's not a very good return on investment. That's a 1% ROI from an actual on paper money standpoint. But if that company has some significant growth prospects, they can grow into that price to justify it. So it's yes, we can look at historical averages, and sure, that's a decent indicator for whether you're getting a good value or not, but it's not the end all be all or only
hmm.
thing to consider as
Yep.
well.
And some companies with high PE ratios continue to have high PE ratios because investors think that they are worth investing in, and that's what matters. Like
Amazon's a
the
great example. Like they
yeah.
broke the PE mold forever. They were always at like a
Hmm.
200 PE, and no one can make heads or tails of why their stock price kept growing. But Jeff Bezos was like, I don't want profits. I want to grow the company, and we're
Yeah.
going to take every dollar we earn, reinvest it into this business, and get bigger and bigger and bigger, and turn into a 600-pound gorilla or whatever 6,000-pound gorilla. Um, and just take over the world. And it kind of all right, PE is no longer a reliable source of measurement
Right.
for a company's value.
Yeah. So I mean, what determines the stock price is what someone's willing to pay for it and what someone's willing to sell it for, right? Like that's what determines the stock price ultimately. So this is just like one of those underlying things that tells us a little bit more about how that stock price is translating into what the company is actually doing and earning. But so yeah, historically, like compared to averages in the early 2000s, those PE ratios were incredibly high because these companies just weren't earning enough to kind of make that PE ratio look like it made sense. And like Corey said, like Amazon's PE ratio was super high and they still ended up ultimately being very successful. But if that's happening across lots and lots and lots of different companies, like there just may not be the market to support that, to turn that into earnings eventually. But yeah, so in the early 2000s, we saw this massive sell off in the domestic stock market. We sometimes refer to the 2000s as like the lost decade in the US stock market. And then, it slowly recovered until 2008 when the housing crisis happened, and then it crashed again, right? So international markets kept chugging along to a certain extent. Like they were affected by these things as well, just not as much. So it actually ended up holding its value a little bit better. But just as a couple of examples, the S&P 500, this is like one of the indexes that we can look at to kind of measure like how did it do over this period of time. It closed at 1,320 at the end of 2000 and then went down to like below 900, started to recover, got to like almost 1,500 by the end of 2007 before the housing crisis happened. And then it went back down to 900 again, which is like well below what it was in 2000, in 2008. And then it only recovered to like, a little under 1,300 by the end of 2010. So at the end of 2010, it literally closed at a lower point than it was at the end of the year 2000. So there was no growth in the S&P 500 for a decade. Like realistically, yes, there was. Like it went up and down that whole time period. But from that starting point to ending point, like it was down, which is kind of crazy to think about. Like we don't think about that happening very frequently. Yeah.
Yep.
So
Yeah,
be diversified.
from its 2007 peak, it didn't reach a new all-time high until 2013. So it was like 5.5 years, I want to say. But yeah, like Rachelle said, international stocks did all right during that time period. They had their ups and downs. Emerging markets had a great run. So um, be diversified is the short answer to all of this. We don't know what area is going to do well or poorly. Spread the risk around a little bit, and hopefully over the long run, things will do well in aggregate. But it also is a good reminder that in the short term, if you need money soon, don't put it anywhere near the stock market because who knows what's going to happen to that money in the short term.
1,000,000%.
Long term, especially the longer you stretch out, the more likely the chart is going to move up and to the right. But in the short term, it's anyone's guess. So,
Mhm.
um, will it happen again? Probably. When? I don't know. What sector? I don't know. What thing? I don't know. Is it crypto? Is it AI? Is it housing? Is it tulips? Like, who knows? Organic cotton, like all the everyone's buying organic cotton, everything now. Like, is there going to be a cotton bubble? Or are we going to start making synthetic organic cotton? Is that even
Ew,
possible?
stop it, Corey. No,
I'm
only organic
Hey,
cotton
you can make
forever.
synthetic diamonds. Like, they're just as good as the real
Synthetic
thing.
meat. Yeah.
Yeah, synthetic meat is I'm a little more skeptical about.
I eat it all the time.
So, but yeah, like anyways, so markets are very unpredictable. We
Yeah.
don't know what's going to happen in the future. I mean, we've referenced PE before as an easy to look at measurement of valuations, and are you getting a decent value, a decent bang for your buck on the price that you're paying for this stock? But it doesn't necessarily tell us if a company will be successful moving forward. Like right now, the trailing PE ratio of the S&P 500 is around 28, which is a bit high for historical averages. We talked about that 16 to 20 number being that historical average. But looking at backwards averages doesn't tell you the story about the future. Like it's essentially the same as looking at average historical lifespans to try and predict future life expectancy. I think it's probably safe to assume, barring an asteroid hitting the Earth, the future life expectancy for people is probably going to continue to increase over time just due to advancements in healthcare. Like you guys are doing that for us, keeping people alive longer, curing diseases, more knowledge about what's healthy and unhealthy. People are trying to hopefully eat healthier, exercise, stay in better shape, etc. Some people, but
Yeah, I think that that's optimistic, Corey. But yeah, health advances.
or you
Woohoo.
could you could take the magic pill or shot to make yourself healthier. Um,
They're like, I'm going to take this pill to counteract the effects of alcohol
yeah,
that
but
I
it's
drank last
like
night.
it's like all right, average lifespan in the 1700s was like 38 years old, and then you died of scurvy. That's not an issue nowadays. So I
Or in
think
childbirth.
yeah, or
Sorry.
the infant mortality rate. Like people had a lot of kids because you had to diversify. You were going
Oh
to lose a
no,
few of them.
stop. Okay,
I mean,
moving on.
not to be. So yeah, like looking backwards, it can help contextualize some things, but you don't want to put all your weight into past data. It's like driving in the rearview mirror. I could make an argument. There's a lot more money around. I mean, it's not an argument, it's factual. There is more money around today than there ever has been at any point throughout the world's history. More people today in a gross number and a percentage standpoint own stocks than ever have
Yep.
before, thanks to
It's a lot more
technology.
accessible.
Yeah,
Mm-hmm.
you could open a Robinhood account and start trading within 5 minutes. You can buy fractional shares. You don't need a lot of money. You used to have to like have money and call a broker and wire funds and pay a commission. Like, unless you had tens of thousands of dollars to invest, you couldn't invest.
Yeah.
You had to buy stocks in lots of 100. Now you can buy an ETF with fraction. You could put $5 and be diversified across the entire US stock market if you want to. Very accessible. More people are participating in 401k plans than ever. So
Mm-hmm.
more people own stocks. There's more money around. There are fewer publicly traded companies today than there were 10, 20 years ago. More on this in a little bit, but there's less reason to go public now because there's more money available for private funding, which means these public companies aren't just these speculative things trying to grow. Like companies that go public now are well established. They have a history, they have a track record, they've got
Mm-hmm.
revenues, they've got products, they've got
Yep.
a positive future outlook. So it's a little bit less risky in the long run. That doesn't mean their stock is guaranteed to go up. It just means that it's a little bit of a safer bet than, buying a company in 1998 was. Um, so more money, fewer companies, greater demand, less supply. That's going to drive the price up. That doesn't mean things are overvalued and the price is likely to come down. It just might be the new normal. We've got more money to go around, less areas to invest it. So it's going to change the supply demand imbalance and change that price to earnings ratio. Maybe instead of a PE of 18, the new normal is going to be 28 moving forward. Like that's just what it's going to be. Um, just like housing prices or cars or, look at anything. That's just the new normal price of things. So technology's advanced, things have changed, things are, more expensive now, except TVs. Those keep getting less expensive. Still don't
Yep.
understand that one.
Yep. I think when you like Google, it's like, okay, the arguments for the bubble is that like valuations are high. Okay, we just talked about that. Like that's not the be all and end all of everything.
And some of these
Investors are
AI
excited.
companies aren't profitable. But, like
Yeah.
take OpenAI, for example, they are not profitable. It's estimated it's going to be a handful of years before they're profitable, even though they're valued at like $500 billion. They're a private company, but they have all the big tech companies heavily invested in them. And I mean, yeah, I think there's a lot of positive future prospects for them, even if on paper right now the revenues aren't exceeding the costs. But
Mm-hmm.
I guess time will tell.
Yep. Yep. Investors are excited. We're buying things even when they're super expensive. Like people keep buying NVIDIA and it keeps going up, even though like the cost to buy NVIDIA is a lot higher than it used to be. There's also just lots of spending, like Corey was just talking about. Like these companies are spending a lot of money because the infrastructure required to do like to facilitate these technologies is huge and it's expensive. And we don't necessarily have all of the applications and people willing to like spend money yet on what AI can do. So there's like, how is this all going to translate eventually into making money. And we don't have all of that worked out quite yet. But it seems like there are a lot of potential ways to use and apply these technologies. So it's hard to know exactly how all of that's going to play out longer term. The arguments against this being a bubble or like a bubble is that, there's some better business models in place. There's more fundamentals. Like these companies, even if they don't anticipate making profits in 5 years, have a plan to make profits in 5 years. And these plans are more detailed and less speculative, you know what that word is, than they were in the late 90s. And it's just different market dynamics. Like Corey was talking about, just more money in the market, more people wanting to invest means that valuations can potentially be higher without it being a problem.
And we're
Yeah.
looking at valuations for publicly traded companies because that's all the publicly available data is there for. Like
Yeah.
there's way more private companies than there are public. I think right now it's estimated there's 140,000 companies worldwide that are privately held, can't buy their stock, with annual revenues in excess of $100 million. I think 19,000 of those are in the United States, versus about 19,000 public companies
Or
worldwide
publicly
with those
traded
revenues.
companies.
Publicly
Yeah.
traded companies, yeah. About
Yeah.
2,700 companies in the US that are publicly traded with annual revenues in excess of 100 million. So there's vastly more private companies. It's also become a lot more accessible to invest in private companies. Like there's been a huge increase in private equity funds, more access to everyday investors like yourselves to invest in those funds. It used to be like you had to, have millions of dollars or be, a billionaire to get access to these things. Now, like some of them have minimums as little as $5,000, and through the pool of the masses, they can increase their funding. They can back these private companies. And if you don't have to go public, there is no reason to. It sucks going public. There's a lot more regulation, a lot more scrutiny. You got to report all
Hmm.
of your financials quarterly. Like it's a lot more expensive to operate. You got to have teams of accountants and lawyers, and you got to
A
deal with the
board
media
and
and the public. There's just so much. Like it's a pain in the butt. So if you don't like the reason historically companies would go public because they needed the money to grow,
they had to
to
raise
get to the
capital.
next level. We got to raise capital. We can't get enough outside investors right now that are willing to give us money. So let's go to the public, issue a stock, sell the company, or part of the company, I should say, to raise that money so we can invest in the next phase. And then I would say over the past 10, 15 years, the argument for going public has, on one hand, been that let's get funding, but on the other hand, has somewhat been to get the investors an opportunity to cash out. It's like, all right, we had all this money come in from, the founders, outside angel investors, venture capitalists, private equity. They want to get their payday. Let's go public, give them the return on their investment. Now, I mean, you don't even have to go public to do that. Like, all right, let's just sell a chunk of our company to Apollo or KKR or whatever the hot PE firm is. Owners get their equity payday, and we can stay private. Everyone wins. Investors get
Hmm.
their payday from the early investors as the larger PE firms buying the shares. So yeah, it's a lot easier. Maybe easier isn't the right word. Um, if you don't have to go public, there's no reason to go public nowadays. So
Hmm.
easier to stay private, easier to grow into a large behemoth as a private entity, and it's kind of changed the investing landscape a little bit, which we'll probably talk more in the future. I think we've done a tiny bit in the past on investing, diversifying. It might make sense to have a sliver of the portfolio in private markets just for that exposure. Even though there is less regulation, less information, less transparency. So it's,
Hmm.
you know, pros and cons with all that stuff,
Yep.
but there's also a lot of
Yep.
growth opportunity and potential there. Um, so yeah, but it has changed valuation dynamics. It has changed how we view companies and what's considered a good investment, what's considered a bubble. Is a company overvalued or not? Just because there's a smaller pool and more money investing in that pool through like 401k plans and whatnot. It
Hmm.
doesn't necessarily mean they're bad companies just because their valuations have increased. That just might be the new normal.
Yeah, totally. I think it's important to note that like everyone has their biases, and obviously we do too. I think that coming into this, I was like, I don't know where this is going, but obviously we're fairly optimistic. And that doesn't mean that we're not going to see ups and downs in the stock market. Like there will be both. Like we might not be in a bubble, but that doesn't mean that we're immune to a stock market correction. Like we can totally see that coming. It just depends. Like market conditions are incredibly complicated. There's lots of different things that feed into them. So when you're a long-term investor, like focus on the long term. Like Corey was talking, up and to the right, if you give it long enough, usually, always in the past, our best guess is that that will continue to happen in the
No
future.
guarantees, of course.
Yeah, our best guess is that that will continue to happen in the future, but we don't know for sure. And I think that when you're a long-term investor, you can generally realize, okay, I can ride out market conditions, whatever they are in the short term, as long as I don't need my money in the next few years. And if you do, probably just put it in a high interest savings account, use some CDs, put it in a money market. Like there's lots of like fairly safe ways to like at least earn some interest without taking on the risk of the stock market, because there's always risks, even if we're not in a bubble.
Yeah, we're not saying we are or we aren't. Rochelle and I have no idea. We're just saying
Nope.
here's some
We don't
arguments
know.
for, here's some arguments against. Who knows what's going to happen moving forward? Yeah, if you need your money soon, don't put it anywhere near the stock market. I think that will always be a good recommendation. If you don't need the money for a long period of time, stock market's still probably the best and most accessible way for growing your wealth over time. Um, so
Yeah.
it's but you just got to be willing to put up with the inevitable downturns that are bound to happen, and they will happen. They've happened throughout history. They will continue to happen into the future. As long as there's people on this planet that have emotions like fear and greed, then there's going to be ups and downs and swings and bubbles. But hard to tell until after the fact, um,
Hmm.
if we're in one or not.
Yeah. So we didn't answer our question. Are we in
No,
an AI bubble? But that's okay. I
because not
think.
only do we have to try and guess what future earnings are going to be, you also have to try and predict what people's
Reaction to it will
expectations
be. Hmm.
of what they think future earnings will be. And that's a really hard guessing game. Like, what do we think people's emotions are going to be this month, a year from now, 5 years from now, relating to this thing? Because that's
Hmm.
what change, like the prices isn't, I mean, in the long term, it's fundamentally driven. Are these companies making money? But short term, it's again what people think is going to happen that's driving the prices. So if people are optimistic in aggregate, then yeah, price probably continues to go up. If people turn pessimistic in aggregate, then yeah, price is probably going to go down, even if the underlying numbers are strong. So it's hard to say.
Yeah. I think long story short, be diversified. Pick a strategy based on how long you have to be invested. If it's not very long, don't take on a lot of risk. If you're going to be invested a long time, you can just try to be as consistent as possible.
And know there will be ups and downs, and that's the price you pay to get the long-term returns that investments have delivered historically.
Yeah, no rewards without risks.
Yep. Thanks for listening. We'll see you next time.